The Fed's preferred inflation gauge, the Personal Consumption Expenditures, PCE index, was in line with estimates for October, according to this morning's data. This latest reading comes as some on Wall Street worry President-elect Trump's proposed tariffs will have an inflationary impact on the economy. But our next guest says that won't be the case. Joining us now is Joe Lavorgna. Joe is chief economist at SMBC, Nikko, Securities America, and a former chief economist at the National Economic Council under the first Trump administration. Joe, good to see you. So
Thanks, John. Good to see you.
You say these inflation numbers today are fine, but not great, but that President-elect Trump is going to get it down to 1% next year while moving ahead on tariffs and immigration policy. How does he get 1%?
I'm not sure. It's going to fall about 1%. It's around 3%, give or take a little. So it'll go from 3 down to 2%, which is price stability. And that'll happen, John, namely through a couple of things. Number one, certainly lower energy costs, which filters throughout the economy in so many ways. Energy is such an important input into the production of so many items. And of course, anything that needs to be transported obviously is dependent upon combustible engines and energy. So certainly lower energy costs combined with what I think, John, will be a very supply side led animal spirits increase in capital spending. Capital spending inflation tends to be quite low. And when you have capital investment, it adds to the capital stock or the economy's productive output. And that should also keep inflation down.
Thanks for clarifying that. There's a big difference between down
big difference,
point and getting
I mean, it
down
could be. Look, under Trump 1.0, I mean, inflation was, by the Fed's metric, was actually under 2%. It had a one handle on it.
Right.
So we could get back there at some point. So I'm pretty optimistic inflation is going to come down. And that it's not going to be the problem that we've had the last 4 years.
Now, why won't immigration action and mass deportations shrink the labor supply such that the cost of labor goes up and actually fuels inflation?
Well, part of the problem, John, is that we're looking at if these are illegal workers coming in. In many cases, they're not even part of the official wage data. They're not part of the household survey that measures unemployment. And in some cases, they're probably not even part of the establishment survey, which, by the way, shows that we actually have fewer jobs than what the government was reported. We had data last week from the BLS that showed that in addition to the roughly 800,000 in downward revisions we're likely to see as of March of 24, we lost an extra 400,000 jobs by June. So we're talking over 1.2 million fewer jobs. So there is tremendous unused labor, you could argue, in the United States economy. And therefore, this notion of deportation somehow leading to what economists would call is a leftward shift in the labor supply curve, I just think is completely inaccurate.
So you don't buy the argument that the jobs that these immigrants are doing are jobs that the people on the books don't want to do?
No, what I'm saying is I don't think in many cases the people that would be deported are functionally a real integral part of the market. In fact, if we look at deportations under President Obama, we had about 3 million deportations over his 8 years. And under Trump's first term, there was less than 1 million, according to the ICE data, ICE, which is part of DHS. So, no, I don't think that, we're going to somehow have this shortage of labor supply. By the way, if we look at the labor market, what we're seeing is job growth slow, labor supply, labor force participation still below its pre-pandemic peak. And we're seeing wage pressures moderate. So we're not going to get inflation from less labor. And by the way, inflation is not a labor phenomenon anyway. It's a money and credit phenomenon.
Let me get
too much money chasing too few goods.